While every headline this week was focused on red candles and market sentiment, three separate events quietly lined up in the background, and together they tell a story that most retail investors are not going to understand until it's far too late. The first, Ripple confirmed directly and on record that they are in the room with Donald Trump, not around him, not adjacent to him, with him, helping design the actual rules of the road for crypto in America. The second, a lending protocol amendment called XLS66D, is advancing on the XRP ledger right now. And when you understand what it enables, specifically in the context of the DTCC, the scale of what's being built quietly in the background becomes almost impossible to overstate. And the third, XRP ETF shares are now being used as institutional lending collateral. And that one sentence contains more structural significance than anything discussed in the past 6 months. Pull up a chair. We're going deep today. Welcome back. This channel exists for one reason: to cut through the noise and show you what is actually happening beneath the surface. No price predictions, no hype cycles, just structure, data, and the cold logic of how financial infrastructure actually gets built. Not financial advice, this is analysis. Now, let's get into it. Let me start with the hard truth that most people in this space refuse to say out loud. The majority of retail investors in crypto are watching price. That's it. They check the chart in the morning, they feel good when it's green, they panic when it's red, and they form all of their opinions about what's happening based on a number on a screen. But that's not how systems are built. When the internet was being wired in the 1990s, the companies doing the actual work, laying fiber, designing protocols, negotiating with governments, were not trending on television. They were in quiet rooms, boardrooms, regulatory hearings. They were present in the spaces where decisions get made. And the people who understood that dynamic, who recognized that presence in the right rooms is worth more than any product launch, those are the people who built generational wealth. Ripple has just told the world, clearly and openly, that they are in those rooms right now. Not metaphorically, not we have a good relationship with regulators. Their own executive describes sitting down with crypto leaders and Donald Trump directly, helping to design, in their words, the rules of the road. The Genius Act, the Digital Asset Clarity Framework, every major piece of regulatory architecture being laid down in America right now, Ripple has had a seat at that table. Think about what that actually means for a moment. When you are the company that helped write the rules, you do not have to fear the rules. You are not scrambling to comply. You are not subject to regulatory surprise. You are already built to the specification, because you helped draft the specification. Brad Garlinghouse didn't stumble into Trump's orbit. This was deliberate, strategic. Years of building relationships, supporting the right people, and making sure that when the moment came where blockchain infrastructure was going to be discussed at the highest levels of government, Ripple was not watching from outside. They were inside the room. David Schwartz has said for years, the technology is only half the equation. The other half is institutional trust and regulatory clarity. That second half, it is now being delivered. Now, let's talk about the DTCC, because this is where the numbers get serious. Most people have heard the figure. The DTCC clears and settles somewhere in the range of $2 to $3 quadrillion in transactions every single year. That is not a typo. Quadrillion, with a Q. The Nostro and Vostro account system, the pre-funded liquidity buffers that banks maintain around the world so they can settle cross-border transactions, has an estimated $27 trillion locked in those accounts at any given time. $27 trillion sitting idle, doing nothing but waiting to be available when a transaction needs to settle. That is the inefficiency Ripple was built to eliminate. Now, here's where XLS66D enters the picture, and why this amendment matters more than most people understand. XLS66D defines an on-ledger lending protocol on the XRP ledger using vaults, loan broker objects, and loan objects. designed specifically with institutional use in mind. Fixed-term loans, funded by pooled assets, structured for scale. And Ripple Prime is now an NSCC participant. That means the DTCC's own infrastructure can face Ripple Prime directly as a clearing counterparty. Let's do the math on what this enables. A broker-dealer clears a trade through the DTCC's NSCC in the traditional way. Obligations net out in DTCC systems. But Ripple Prime's margin and financing? That gets managed against an XRP ledger pool. A pool funded by institutional lenders depositing XRP or RLUSD into a single vault structure running through XLS66D. What that means practically, the DTCC never has to change its own operational model. It never needs to touch a blockchain directly. It sees Ripple Prime as its counterparty, familiar, regulated, compliant. But behind that interface, the actual liquidity management, the collateral movements, the funding legs, those are running natively on the XRP ledger at 1,500 transactions per second, with finality in 3 to 5 seconds. Here's the math the crowd is missing. If even a fraction of that $27 trillion in trapped Nostro and Vostro liquidity begins cycling through this architecture, the demand for XRP and RLUSD as the liquidity layer is not a prediction. It is a structural requirement. You cannot run the system without the fuel, and XRP is the fuel. Now let's look at how the smart money is already moving on this thesis, because the signal is loud if you know where to look. Start with the ETF flows. Most of the major crypto assets right now are seeing net negative inflows. Institutions are exiting positions in Ethereum, Solana, and others. The money is moving out. XRP ETFs are doing the opposite. And it's not just inflow volume that matters here. It's how those ETF shares are being used. Brad Garlinghouse confirmed this week that XRP ETF shares are now being accepted as lending collateral. Institutional counterparties, banks, brokers, clearinghouses, are accepting XRP ETF shares in lieu of cash or treasuries for margin, repo, and derivatives exposure. Let me explain why that is an enormous structural shift. When a major institution pledges an asset as collateral, they have completed a risk analysis. Their legal team has signed off. Their compliance department has cleared it. Their risk management system has assigned it a haircut value. That process does not happen for speculative assets. It happens for assets that are considered liquid, transparent, and safe to hold on a balance sheet. XRP just passed that test at the institutional level. Every ETF share posted as collateral must be backed by real XRP held by the fund. That means collateral demand drives creation demand, which drives persistent buy pressure on the underlying asset. The supply that moves into ETF cold storage does not return to market for a 10% gain. It is locked. It is pledged. It is serving as the foundation of billion-dollar credit arrangements. And then there's Amina Bank, now the first bank globally to directly support RLUSD with custody and trading. They're integrated into 21X, the European Union's first fully regulated DLT-based trading and settlement system. Amina is using Ripple payments as its cross-border payment stack, RLUSD as its house stablecoin, and the XRP ledger as its settlement rail. Europe's regulated institutional tokenization infrastructure now runs on Ripple technology. That is not a partnership announcement, that is a live production deployment. So when does this system go fully live? What are the actual trigger events to watch? The Genius Act is moving. Stablecoin legislation that provides the legal framework for RLUSD to operate within the U.S. financial system, not as a gray area product, but as a fully compliant, regulated, dollar-denominated asset. When that passes, the compliance gate that has been holding back the majority of U.S. institutional adoption of stablecoin-based settlement disappears overnight. The Digital Asset Clarity Act is in parallel motion. For the first time, there is a real legislative framework establishing what counts as a commodity versus a security in the digital asset space. For Ripple, who fought the SEC case specifically to establish that XRP is not a security, this act is the policy-level confirmation of what the courts already told us. XLS 66D itself is in the amendment process. Once it passes on the ledger, the institutional DeFi infrastructure, the vaults, the loan broker structures, the programmable lending rails, goes live. Evernote is already exploring it for yield generation. Ripple Prime is already positioned as the institutional counterparty. And once the OCC bank charter and Federal Reserve master account that Ripple has been pursuing comes through, and it will, the last gate between Ripple's infrastructure and full integration with the U.S. banking system closes permanently. Each of these catalysts alone is significant. Together, they are sequential dominoes. Here's the dynamic that almost no one is discussing clearly. XRP has a fixed supply of 100 billion tokens. Of that, approximately 55 to 57 billion are in circulation. But here's what's changing rapidly. The amount of that circulating supply that is actually accessible on open markets is shrinking. ETF shares pulling XRP into cold storage. Ripple Prime building institutional vaults on the XRP ledger. Banks and custodians using XRP ETF shares as pledged collateral in credit arrangements. Every one of these use cases removes XRP from the tradable float and places it into structures where it does not return to market easily. We are transitioning, right now, not in some hypothetical future, from a market structure where XRP is a retail-traded asset to one where it is institutional infrastructure. And infrastructure is not for sale at any price. Once a token enters a multi-signature institutional vault as backing for a $500 million credit facility, it does not come back to market because the price went up 20%. The window where retail participants can accumulate at these levels is not permanently open. Ripple is globally positioned. Bank of America, Santander, Westpac, Royal Bank of Canada, Tokyo Mitsubishi. The Dubai Land Department is tokenizing real estate on the XRP ledger. The infrastructure is not being planned. It is deployed. The supply is draining. The institutions are present. The question is whether you're watching the noise or the structure. I know what the chart looks like right now. I know it's been a frustrating few weeks, down roughly 21% year to date. And the natural human reaction to that is to question everything. Let me offer a different frame. XRP is outperforming Bitcoin, Ethereum, and Solana year to date. In a market defined by fear and uncertainty, the asset with the most institutional infrastructure, the most regulatory clarity, the most active financial system deployments, is holding its relative value better than almost every alternative. That is not an accident. That is the market beginning to differentiate. Being early feels exactly like being wrong, right up until the moment it doesn't. While retail is focused on the price, Ripple is in rooms with presidents and prime ministers. The Dubai Land Department is tokenizing real estate on the XRP ledger. The DTCC's own clearing infrastructure is interfacing with Ripple Prime. XRP ETF shares are being used as margin collateral at the institutional level. The Genius Act is moving through Congress. The signal has never been stronger. The noise has never been louder. And that combination, historically, is exactly where conviction gets built, or where it gets abandoned by those who only knew the story when things were comfortable. The question is, which camp you're in. Here's the single most important thing I want you to take away from today. Ripple is not a company waiting for permission. They are a company that helped write the permission structure. They are in the regulatory rooms. They are in the presidential advisory sessions. They are building the clearing infrastructure that sits between the DTCC and the blockchain. They are the stablecoin behind Europe's first regulated DLT settlement system. The architecture is almost complete, and the people who understand that are not the ones selling right now. Price is a distraction. Structure is the reality. Drop structure in the comments if you made it to the end today. I want to know who's actually paying attention. Stay patient. Stay rational. The system doesn't lie.